Well, as I understand it, you're starting to work on the new Tackle 25,
I am. I am.
25, list, I guess is the word I was looking for.
I am.
So the fact that you're working on that, I've got a little something for you today to maybe help you out with that.
Okay.
We're talking about valuations
Now,
here,
mind you, there are 11 criterias for the Tackle 25 that are set in stone for the last 7 years.
and
What
we're
do you
not
got?
gonna and we're not gonna change them. What I'm gonna do is add to them. Okay.
I love
Um,
that. I love that.
so the reality is in those seven metrics that you have, it's about valuation. That's what fundamental analysis does.
Can
Is
can
it
I
helps
say
us. Sorry,
can
go
I
ahead.
just say one thing to that, Greg, and then I'll be quiet and let you fly. When you look at it, when you look at the criteria for the Tackle 25, honestly, there's lots that go into it from a fundamental perspective. But honestly, the question you're trying to answer is proper valuation. In all the different metrics you look at, you're trying to understand the ultimate question of, is the price of the stock a worthy price to pay for it? And that's all about valuation. And I just wanted to add that, Greg. Go ahead.
Yeah, and that's exactly what we're going to be talking about today. Is that's really only that's the only question I think that any investor, and let's take Uncle Warren Buffett, right? His whole investing philosophy, if you break it down, is you know what's the value of a company? Is it fair value? Am I willing to buy it? Right. Well, that's what we're looking at and we've been doing this for a number of weeks now, is we're looking at different ways to value companies. We're looking at different metrics. You've got some in the Tackle 25. I've discussed some here. We've got a few more, that one that we're going to talk about each week. And so this week we're going to talk about something let me just back up to before Thanksgiving there. We talked about enterprise value over revenue. Okay. So basically we were trying to decide what is the value of a company. When we look at the price, not only the price of it, right? The price gives us our market cap, but not only that, but what's under that price, what's under the hood of that company. That's where we get our enterprise value in there. So when we start talking about enterprise value, we're looking at the valuation of a company. How is it doing in comparison to something else, right? So the last time we spoke, we talked about comparing enterprise value to revenue. How much money is actually coming in, right? And so I'll tell you something. All of these metrics that we're talking about are also the metrics that other companies use when they're going to buy a company. So if we can take a page out of Warren Buffett's book, or we could take a page out of a merger book, they're going to evaluate these companies the same way. It's probably going to work pretty well for us to look at these same things. So this is what we're talking about here. So basically, let me just go through this real quick. So market cap is the size of the company based on the price and the number of outstanding shares. That doesn't really tell us anything except how big a company is, which is good, right? That does lend some credibility to a company, right? Obviously, the larger companies tend to do a little bit better than the smaller companies from an income standpoint. But once we look at enterprise value, what it does is it takes the total value of the company, including any debt and cash. Okay, so we talked about this a couple of weeks ago. You guys go back and watch that halftime report. But essentially, it's giving us a better metric of what the actual value of that company is. Okay, so now we have that enterprise value. Now we can take that comparison. We understand the debt and the cash on hand and all the inner workings of the company itself. And that gives us a number. Now we can start comparing that. Well, last time we compared it to revenue. Well, revenue is just how much money is coming in. Okay, that doesn't take into account all the other things that go on in the running of a company, in the business, I guess, processes of a company. So this is where we're going to start talking about Ebitda. So Ebitda is just essentially earnings before interest, taxes, depreciation, and amortization. What does that mean? It's a lot of jargon, I get it, but let me just break it down for you. It's an alternative to looking at net income. So you could have your revenue, you could have your net income, and your net income takes into consideration a few different metrics. This EBITDA takes into consideration pretty much everything, and including accounting practices. Okay, so why does that matter? Well, if we take one company and they do their accounting a certain way, and then we take another company and they do it a different way, and we don't take into consideration the way they report their numbers, that the numbers that we look at are going to be skewed. Therefore, the valuation that we're looking for could also be skewed. We don't want that. We want raw numbers that give us a very clear picture of what we're looking for here. So EBITDA gives us that. So when we start looking at, earnings before interest, taxes, depreciation, and amortization, and we take that enterprise value and we divide those two, what it does is it gives us a multiple or a ratio. This multiple tells us, okay, how much are we paying for the value of this company with all of these other things like interest, taxes, all that stuff taken into consideration. Now, why does this matter? Well, it matters because we can compare two companies that are very, very similar in what they do. And we can also take into consideration any differences, micro differences that they may have. Like I said, accounting principles or accounting practices are probably the biggest one in there. So now we get to compare literally apples to apples. Okay, so this multiple, basically we're streamlining the number. We're getting a clearer picture than if we just use net income or revenue. So what we want to do is just compare these companies, and the way that we can do that very simply, one of my favorite places to go is Yahoo Finance. Okay, if we go to Yahoo Finance, I'm just throwing KO here. We've already got it up. But if we throw in Coca-Cola here, you're going to see that this gives us a bunch of different numbers just across the top here. Well, we want to go right to financials. If it'll come through for me there. There we go. And so this is going to give us a bunch of stuff right off the bat. Sorry, I apologize. Statistics, not financials. Making my own mistakes. If we go to statistics here, this is going to give us, it says right at the top here, valuation measures. Okay. We talked about enterprise value with revenue, right? And this is the multiple that I was talking about. Now we're going to look at this number here, enterprise value over EBITDA. This also gives us a number or a multiple number. What we want to do is be able to compare this against a similar company. And that way, like I said, it takes into consideration everything. It's a more focused number. And now we can kind of compare it. So let's say we're looking at Coca-Cola, right? It's a beverage company, and it's got a multiple of 17.38. Okay, now the thing that you need to know is the lower the multiple, the more of a quote unquote bargain potentially the company is, because meaning that enterprise value, there's value to that, and then we're dividing it by that EBITDA, which takes into consideration how much it's actually earning with all the other things worked into the number. This gives us that clear picture. So if we go to another beverage company, Pepsi is always one that I like to look at. We can sit here and say, well, they're different stock prices, but they have similar numbers when it comes to valuation. But we can see here that enterprise over EBITDA, sorry if I can get it back there, they're 18.23. So if we just took that number and compared it, we got Coca-Cola at 17 and we got Pepsi at 18, we would say that potentially Coca-Cola is the better value. Now, of course, that's not going to be, we're not going to use that only as a metric. There's other metrics that we've gone through and that we're going to continue to go through. But this is yet another one where we've really drilled down the number to say, okay, what is the valuation of this company? How is it that they're running their businesses? And does it make valuation sense to us? And so, Matt, when you're using the Tackle 25, you've got your own metrics in there. This is just another one of those metrics that we can use in a comparison tool between companies and really give us that apples to apples comparison.
Coach Greg, absolutely love it. Thank you so much for another fine edition of Fundamental Focus. You are the best at fundamentals at Tackle Train. Really appreciate that, and always appreciate your insights there, Coach Greg, in the Halftime Report. Our community and myself, thank you for coming on every Thursday in the Halftime Report. And Greg, thank you for all you do for Tackle Train. Really appreciate that as well. Greg, let's go ahead and have some final thoughts as we navigate a choppy market this week. What are your final thoughts, my friend?
I think we said it right at the start. We've got to get some follow through on these markets, right? The volatility is, still high. We got to get some follow through. I have no interest, like I said earlier, until it gets above this shelf. I've got no interest. I need to see the volatility subside. I need to see some support here, and then you can dip your toe back in the water, so to speak.